Hey, what's up, traders? It's James again, and this is going to be episode 2 in the beginner's course of basically like what is trading and the difference between stocks and futures. And we're going to throw some cryptos in there too. So my main goal here is to get you over this like overwhelmed period and get you into our next lesson of setting up the charts and get into the fun stuff of taking the trades. So bear with me and we'll get going right away. Okay, guys, so again, my main goal here, just like in the first episode, is to get you over the overwhelm and get you to understand what we're doing here so that we can get into the fun stuff like setting up the charts and getting traded. So I'm going to try to keep this as short as I can. I've got just a few slides and I'm going to show you some chart examples and we're going to get right to it right now. So this is episode 2 in the beginner's mini course, what is trading and the difference between stocks and futures. Like I told you in the intro, we're going to do some crypto stuff too, just because that's all that jazz these days. And I'm going to show you why I think you should avoid it. Okay, so what is trading? Let's get to that. It's in my opinion, it's actively getting in and out of positions. Now, this is a broad stroke because I just really want you to differentiate that between that and something like investing or having a 401k or a mutual fund or something like that, where you kind of like it's kind of in the background. You're putting money into it every month, year, whatever the case may be, and you're letting it grow and you're not watching it day to day. Trading is more of like getting in and out of positions, and that can be we have some traders trading a couple hundred times a day. We have other traders trading once every couple days. To me, I think it's a minimum of 3 to 5 trades per week to be considered an active trader. That's really my kind of opinion on the matter. But again, this is, you talk to 10 different people, they'll tell you 10 different things. But it's certainly not long-term investing. Now, we're going to talk about futures now and dive into what are futures and trying to get you to understand the basics. What futures is an agreement to buy or sell something at a fixed price at a specific time in the future. That's why it's called a futures contract. It was originally used for commodity price stability. Think wheat, soybean, stuff like this, where you have producers on one hand and you have the end customer, and we're trying to eliminate huge fluctuations in the price, putting people out of business, and to stabilize these commodities a little bit better. And then over the years, that's evolved into more speculation due to their leverage nature. Technology's advanced us to be able to trade indexes or indices on the futures markets, as well as financial futures like some currencies and interest rate products and stuff like that. I'm going to show you some chart examples, but before I do that, what I want to do is I want to show you a very quick 1.5 minute video from Investopedia that explains to you like why futures markets were made. And that basically is going to be where we stop with the why is a futures market there, because you really don't need to know anything about the why, because you're not going to be actually holding these contracts anyway and shipping somebody a bunch of goods or receiving a bunch of goods. You're just using these futures markets to speculate, okay? So if you just give me 1 second, I'm going to pull up the video and I want you just to listen. It's a really quick one and I think it gets right to the point. Instead of me trying to explain it to you, let somebody that's done this before and made a production out of it explain it and very quickly, okay? So just bear with me. I am going to pull this up, make it bigger, and then I'm going to let you listen to this and let them do the talking. Okay, here we go.
A futures contract can protect producers and suppliers from price changes. Al's Ice Cream buys milk from Tim's Dairy to make its ice cream. The price is $2 per gallon. At this price, Tim profits from the milk it sells, and Al's profits on every ice cream cone it sells. One day, a new dairy opens and the number of cows doubles. The extra milk pushes the price of milk down to $1 a gallon. Al's is making more profit as costs drop, but Tim's is losing money. Later, a sleeping sickness knocks out 3/4 of all the cows. Milk rises to $4, and Al's profit per ice cream disappears. Both companies want to avoid this price volatility. They both meet with an investor. Each company negotiates a separate contract with the investor. For Tim's Dairy, the contract states that if the price of milk goes below $2, the investor agrees to pay the difference to Tim's. If the price goes above $2, the investor gets to keep the profits. Al's contract with the investor works the opposite way. If the price of milk goes above $2, the investor pays the extra money and Al's gets milk at a predictable $2. If the price dips below $2, Al still pays $2 and the investor collects the profits. By locking in the price of milk, a futures contract allows both Al's and Tim's to transfer their potential risks and rewards onto the investor.
Okay, guys, so that was really quick, and that's really where we need to stop with like the why behind the futures market. That's why they were originally made, but what we're going to be using them for is speculation. That's what they're often used for here, and that's what the investor in that example was using it for, is to speculate whether, if you think that the market in any of the futures market is going up, you can buy the contract, and if it goes up, you can sell that contract at a higher price and make money on the difference, just the same way you would buy something like, Amazon, if you think it's going up, and then you make money if it goes up, right? That's how you're going to be thinking about a futures contract as well. The only difference here is that the futures contracts are leveraged. So what I want to basically where this is going to end, and I'm going to show you like a chart of examples right after I show you the actual trading chart, and show you like the pros and cons of each. But we start with, naturally with buying power. Now, on the left here is the E-mini S&P 500. It's one of the most common future markets traded, contracts traded in the world. It follows the S&P 500. It's not a commodity based, not oil or milk like the example, or gasoline or any of that. It actually just follows around the S&P 500. Now, the middle panel here is the SPX, which is what we consider the cash, like the stock version of the S&P 500. Now, you wouldn't trade the S&P 500 indice on the stock, but you wouldn't trade the SPX. It's more used for options. But I'm just showing you here as a comparison. You can see that the prices are very much the same, $39.71 versus $39.74. And the only reason that they're not exactly the same is because this one moves in pennies, this one moves in quarters, and then there's an expiration factor to it, which, again, you don't even need to know. I wasn't even going to explain that to you because it's just overwhelming and it's unnecessary. What you really need to know is if I were to buy a futures market like the S&P 500, it is leveraged 50 to 1 over the cash versus the cash. And let's call that versus the SPX, which is what is considered the cash version or the stock version. So this on the left is 50 times worth 50 times this. So what that means is that if I were to buy this market where it is right now, and I hit this blue button, it would allow me to buy the market. I'm just on the paper trader for example purposes. You'll see that this will start moving up and down. Now you're probably wondering, how is it going up and down $12.50 at a time when the stock is only going up 25 cents? Well, it's because it's leveraged, okay? And I'm going to do the same thing over here. I'm going to buy this one, okay? And you're going to see that this is actually going up in pennies, moving around in pennies versus moving around at a much higher denomination. Okay. And again, this is the leverage that your money goes further, okay, in futures because it's leveraged at, in this case, the E-mini S&P 500 is leveraged at 50 to 1 versus the cash, okay, the cash being the SPX. Now, they're not all futures are not leveraged the same. You have what we call the E-micro, and you can notice that $39.74, $39.74, these are the same prices. This one over here is leveraged at 5 to 1. This one's leveraged at 5 to 1. So for every 1 point move, okay, for every 1 point move in the cash, it's $5 over here. Okay, it's leveraged at 5 to 1. So as if you're trading a 1 point move in a stock that's worth $1. A 1 point move in a future over here is worth $5. A 1 point move in the future over here is worth $50. And that's just the way it is, because these are the futures markets and their leverage. So I'm going to put the same trade on over here, and you're going to see that it's moving in $1.25 increments. So this one, okay, over here, leveraged at 50 to 1. This one's leveraged at 5 to 1. So for every quarter, okay, every quarter we move here, it's $1.25. Another quarter, $1.25, $1.25, and $1.25. If you add up $1.25 times four quarters in every point, you get $5 per point. Okay, it's $5 per point. This one is $50 per point. That's why it moves $12.50. Okay, so if you ever wanted to know a futures contract of how much each point is worth, all you would have to do is go to the CME website, and you find out. Here's the E-mini S&P 500. This is the one that's on the left, this one over here. And you would see that it's $50 per S&P 500 index. So, okay, so every point is worth $50, okay? Every point is worth $50. Now, if I were to go over to let's say maybe you wanted to trade the NASDAQ, I can switch over to the NASDAQ and I would see the same thing. You would see, okay, it's $20 per NASDAQ point. So if I would come over here and I would change it to the NASDAQ, I know that it's $20 for every point that the NASDAQ moves. And these things are leveraged. And that's the only thing you need to know about futures is you're not trading oil and you're not going to get a bunch of barrels of oil or something like that. You're using this for speculation, and the leverage is one of the advantages of trading futures. Okay. So I'm going to pull up now. You can see how they're moving much higher denominations here versus here. Okay. And then over here, it's somewhere in between, right? Because this one's moving 5 to 1. This one's moving 50 to 1. This one is, I guess, for example purposes, I should put that this one's moving 1 to 1. So for every cent, it's a cent, and for every point, it's $1. Over here, for every dollar, it's $5, and for every point, it's $5, and for over here, every point is $50. All right. So I'm going to pull up, now that I showed you like that basic example, what I'm going to do is I'm going to pull back up the slides, and we're going to go over some of the pluses and minuses of. We showed the chart examples of future stocks and cryptos. Okay. So the first one, upfront capital. Because of what I just showed you, you actually need less capital to make the same amount of money because you're trading on margin. You're not trading on, okay, in the SPX, think about the middle panel there. You'd have to put up the entire amount and then watch it tick up and down a cent at a time. Here, you're trading on margin and you're watching it go up $50 at a time. Now, I'm not saying that's the best thing in the world, because of course, if you can make more, you can lose more, right? So you need to be aware that leverage cuts both ways, and you've got to really know what you're doing to be able to trade futures. And that's kind of where we come in, and where we're at Take Profit Trader, we're actually funding these traders so you don't have to, risk your own money, because you could lose a lot of money in futures too, just like you can gain a lot of money. Now, crypto, again, people got in love with crypto because you could buy a Bitcoin for fraction of a penny and it could be worth 60,000. So I put crypto as you need less upfront capital. Now it's a little bit, that's kind of where crypto's advantages end. And of course on the chart, I think it goes without saying that green is good, red is bad. For the next part, the trading times. Now this is a very, very big thing here. We're able to trade both of these at the same time. And I don't think I have to go back to the chart to show you, because right now it's 1:53 Eastern time when I'm making this video. But in futures, you can trade 23 hours a day. In stocks, the market opens at 9:30 and closes at 4, and then you've got to wait till the next day. So this doesn't make it advantageous as a trader, because like when you're learning how to trade, it's not realistic to say, I'm going to quit my job today and start trading. No, like futures allows you to kind of have a more flexible schedule, and that's one of the huge advantages of it. I mean, I remember when I started, I was playing professional hockey and I wasn't able to trade when the market was open. Like the normal trading hours, we'll call it 9:30 to 4. I needed to trade. I was in Europe. I needed to trade at a different time when we weren't practicing. And I kind of learned how to trade and learned how to do all of this stuff when the regular market was closed. So I wouldn't be able to practice on the regular market, but I was able to practice on the futures market because it was still open. Now, crypto, that's another advantage of crypto. It's open 24 hours a day. So again, if we're going to be fair to cryptos, that is an advantage. Now, recession proof, when I have the question mark, is people often ask when you're trading, it's like, well, why would I trade if we're going to go into a recession? Because like if the market goes down, I'm going to lose money. Well, actually, that's one of the biggest advantages of futures is all you have to do to make money in futures. I shouldn't say all you have to do and make it sound simple. Like trading is hard, guys, but is you get to dictate which direction you think that the market is going in. And if it goes in that direction, you make money. And if it goes in the opposite direction, you lose money. So when in stocks, you probably heard of short selling. Now, short selling is a little bit more complicated because you got to go to a broker and borrow the shares to be able to bet on the market going down. So it's harder to make money when the market goes like this, right? Crypto is the same. It's harder to short the market. And when we say short, guys, if you're brand new to trading, that just means that you're making money if a certain stock or an index is going down. Now, I'm going to go back because I think this is a really important part. I'm going to go back to the charts real quick, and I'm going to show you. I'm going to close these trades out, okay? Now, if I were to think, okay, guys, I'm thinking that today the market is, the market is going down, down, down. Let's pretend it's not going up today. It's going down, 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 and oh man, I can't make money in the market because it's going down, and I'm going to lose everything. Well, in futures is as simple as pushing the other button, not the buy, the sell button, okay? So now, if this market were to go down, okay, and I were to cover the position, meaning buy it back at a lower price, I've actually made money. You see how the market is ticking down right now? The market is ticking down and this position is going in the green. That means it's because I don't have to ask the broker to borrow some shares to bet on the market to go down. It's as simple as just pushing a button. So futures markets, it's much easier to make money if the market is going down versus if you're trading the SPX or something like that. You can't do it the same way. So that's a huge advantage because in futures, I always tell people you can make money or lose money if the market's going up, down, or sideways. You just got to be able to understand how the market moves and be able to pick which direction it's going to go. Now, if it's going down, we have this saying in the market, stairs up, okay? Stairs up, elevator down. So the markets typically go like this. They take the stairs up and the elevator down. And this is when you would read in CNBC, oh my God, like the world is ending. Well, in fact, a lot of traders in futures make a lot of money when the elevator goes down because it goes down quickly. And since you're able to capture that move and if the synergy of being leveraged a bit will help you make money when the market's kind of doing whatever it's doing. And you get good at figuring out if it's going up, down, or sideways. Okay. So again, not pretending it's easy to do this, but I'm just saying the availability is there to make money if the market goes down, if the market goes up, or if the market is going sideways. You just have to be kind of in tune with the market and figure out which of those directions is most likely to go. Okay, let's go back to the screens and let's do this guy. Okay, so that's where futures, one of the few ways futures wins very big over stocks and cryptos, in my opinion. Now, the regulation, here's a big one too, because in futures, it's you kind of more or less do what you want. You're able to short the market whenever you want. If you think the market's going down, you can just push that button like I just showed you. Stocks is a bit more restrictive. They have more rules on when you can sell the market, when you're able to short it. They also have this thing called the pattern day trading rule, which is basically says that you have to maintain $25,000 in an account to trade more than 3 trades a week. Okay, so a lot of traders that are coming in that are trying to, open up, don't have a whole lot of money to start. They open up a small account. They're not actually able to actively trade because of this pattern day trading rule. And you can look up that, sometimes referred to as the PDT, so people don't have to spell it out, pattern day trading rule. Look it up, and you can read all about it. It's regulated by the SEC, and they make you have $25,000 minimum because trading, they say trading is risky and we don't want people trading with their rent money. They're absolutely right about that. But again, like there's other ways to do it where you're watching your risk. Shameless plug here. We actually fund traders ourselves so that they don't have to shoulder all that risk themselves. Cryptos, I put this one in pink because it's less restrictive on regulation. However, it's obvious, I think, that more is coming with all of these exchanges, like money vanishing. FTX was in the news recently. It depends on when you're watching this video, about billions of dollars just like disappearing in the exchange going out. So we all think that more regulation is coming in crypto. So may not be regulation now. Who knows where we will be in the future. Now, I say exchange integrity. If we want to continue there, crypto is like the wild, wild west. This is one of the places I think that the stocks and futures really separate themselves from things like cryptos and Forex, foreign exchange, because the CME is the big exchange in futures in the U.S. and there's no shenanigans there. It's run by the CME, which is a multi-billion-dollar company, and of course the stocks, NYSE, Nasdaq, and things of that sort. So you don't have to worry about any exchange integrity that you have to worry about in crypto. But that's one of the main goals is to make sure that you're trading something that's not like penny stocks and something that's shady, that even if you make money, you never know if you're going to get it or not. So the exchange integrity is something really big, in my opinion, and something I think that should not be taken lightly. But now that we're done with this, and I mean, we could go on ad nauseum with some of these things and we can get into a lot more depth. But remember what I'm here to do, guys. I'm here to explain to you what futures are and some of the advantages and disadvantages of trading futures versus stocks and stuff like that. And you'll see here, of course, I'm biased. I cut my teeth on futures. I've also traded stocks, and it's frustrating sometimes. A lot of these things I get frustrated with, pattern day trading rule, not so much anymore. But when I started, sure, recession proof, like if you think it's harder to bet against the stock. The trading times are, you would think that now that all the technology we have, these things would trade more around the clock like futures do. And of course, when you're starting out, this one's important too, like the upfront capital you need, because you won't know at first if trading is for you. But of course, you need less of it if you're trading futures to find out if it's for you, right? It's just hard to do that. You spend a lot of time, and you got to spend a lot of time to learn, but you also got to spend a lot of money if you're in stocks, because you need more money to move the needle. Okay. And so that I'll come back to the camera now, because I think that I've kind of beat that into your head already, that the old way was, putting a bunch of money in an account and trying to figure it out yourselves. The new way is with companies, we're not the only one out there, prop firms, where they'll put money in and shoulder some of that risk with you. And then we, have the ability to, use the leverage and stuff to help you out. And this isn't a pitch for Take Profit Trader. It's more of, hey, these are the advantages of trading futures. With the technology that we have now and in this day and age, futures, some of the weaknesses of futures, which I didn't put on here, is like, I touched on it a bit at the beginning, is the upfront capital. Yeah, you need less because of the leverage, but that leverage cuts both ways. Remember, like you can lose a lot of money too. That's why you need somebody to help you shoulder that risk, right? Because trading is all about risk management. So here, the advantages are endless with futures. You know what they are now. I think I've done my job there explaining to you what they are. I think I've also explained to you that once you know what they are, you can kind of put that aside, because you don't need to worry about delivery of stuff or anything like that. We're using it more for speculation. You can have a high level, conversation with anybody of the advantages of stocks and futures. If I've done that and that alone, then I am really confident that we'll seamlessly move into the next lesson, which is setting up your charts so that you can see the market move around, get market data so you can start practicing, because the ultimate goal of this beginner series is to get you trading, take your first profitable trade. Okay, guys, I hope that that's helpful, and I'll see you guys in episode 3.